Welcome to a new market analysis session. Today is February 6, 2026, and we are about to break down the price action for the Eurist pair. Before we begin, it is fundamental to remember that trading foreign exchange and financial products carries a high level of risk and may not be suitable for all investors. The content of this video is for strictly educational purposes and does not constitute, under any circumstances, financial advice or investment recommendations. You are solely responsible for your decisions and the management of your capital. Trading the markets requires discipline and a validated strategy, therefore, use this information as a learning tool for your own technical criteria. We begin our technical analysis by looking at the daily timeframe, the 1D chart, where the Eurist structure reveals a fascinating institutional narrative. After reaching significant highs in late January, the price has initiated a deep corrective phase, seeking lower liquidity levels. Currently, we are testing the PDL or previous daily low area, located near the psychological barrier of 1.18000. Notice how the chart highlights multiple PDH levels at the top, representing buy-side liquidity waiting to be swept in a future expansion move. However, in the short term, selling pressure seems to be targeting the PDL levels from late January, specifically toward the 1.1728 and 1.1668 range. It is crucial to monitor price reaction at these points to determine if we will witness a technical bounce or a continuation of the bearish trend. Dropping down to the 12-hour timeframe, the market structure offers us a much more detailed view of price inefficiencies. Pay close attention to the area marked as the fair value gap or FVG, located just above the 1.16978 level. In institutional trading, these liquidity voids are often high-probability zones where price seeks to rebalance itself before continuing its primary move. The fact that this gap closely coincides with the previous lows from January 23, the PDL 23-01, indicates a very powerful bearish confluence. In this scenario, our focus is on how the interbank algorithm delivers price into this discount zone. If the Eurist pair continues its bearish delivery, we will likely see a liquidity sweep at this level to mitigate the inefficiency before considering any bullish reversal scenarios. Refining our analysis on the 8-hour timeframe, we can see the price delivery of the Eurist pair with greater clarity. Notice how the bearish structure remains intact, respecting the lower highs. In this timeframe, the PDL, or previous daily low, acts as our immediate support zone. However, the lack of an aggressive bullish reaction at this point suggests that the market still has pending orders to collect at deeper levels. The macro objective remains the 12-hour fair value gap we previously identified near 1.16978. It is vital to pay attention to the candle closures in these 8 hours. A close below the current PDL would confirm that the algorithm is seeking external liquidity from the January 23 lows. Exercise patience, as price is moving efficiently toward the high probability zones we have marked in red. We are now moving down to the 4-hour timeframe, a crucial timeframe for confirming the direction of the order flow. As you can see on the screen, I have specifically marked two LH labels, which stand for low or high. This is the visual confirmation of a healthy bearish structure. The price lacks the strength to break above previous highs, indicating that sellers maintain absolute control over the Eurist pair. Notice how every bullish retracement is halted by institutional pressure, validating our resistance zones marked in green, such as the PDH and the early February levels. As long as the price continues to print these lower highs, our bias remains focused on reaching the lower liquidity targets mentioned earlier. This 4-hour structure is the map that guides us, ensuring we aren't misled by small upward moves that are, in reality, simple retracements before a further decline. Moving into the 1-hour timeframe, today's operational scenario becomes crystal clear. Prior to the New York session open, we have already located and perfectly defined the high daily and low daily for the current day. The daily high has been established at 1.18020, while the daily low sits at 1.17649. These levels represent our initial working range and are fundamental to understanding where liquidity will shift during the session overlap. Notice that the price is currently compressed just below the PDL, or previous daily low. This pre-New York consolidation is often a signal that the market is accumulating orders. As precision traders, our task is to monitor whether the high daily is respected as resistance or if, conversely, the low daily is pierced to seek the external liquidity we have been tracking on higher timeframes. We remain on the 1-hour timeframe, closely monitoring the moments leading up to the New York session open. A fundamental operational detail is unfolding right now. Price is showing a clear intention to expand toward the high daily we previously marked at 1.18014. This action suggests that the market is looking to neutralize the liquidity of retail buyers who placed their stop orders just above that high. Notice the candle formation. The bullish momentum is steady, and it seems imminent that the daily high will be consumed before the heavy volume of the American session kicks in. As traders, we must stay alert. This sweep of buy-side liquidity could be a Judas swing or a simple manipulation before continuing the macro bearish trend we saw on higher timeframes, or alternatively, the start of a deeper rebalancing toward higher PDH levels. Notice now the real-time development on the 1-hour chart. As we anticipated, volume has surged, and the current candle has decisively pierced the previous high daily. This isn't just a slight touch, it's a candle of intent actively seeking the liquidity resting above 1.18020. At this stage, the price is confirming that momentary buying interest outweighs immediate supply. This is the critical follow-through. Watching how this 1-hour candle closes will tell us if we are witnessing a genuine breakout or a simple liquidity sweep of the highs before a reversal. Keep your eyes on the upper resistance levels, as the order flow is in full motion. We are now changing timeframes, moving from the 1-hour chart to the 15-minute chart to analyze a highly relevant technical element that has just appeared following the bullish momentum. If you look at the yellow box, I have marked a 15-minute fair value gap, FVG 15M. This imbalance occurs when price delivery is so rapid that it leaves a void of efficient orders. In the current context, after breaking above the high daily, the Eurist pair has left this gap just below the equal highs at 1.18153. What the algorithm is telling us is that, although the final target remains the PDH at 1.18218, there is a high probability that price will undergo a technical retracement into this FVG to mitigate the inefficiency and collect more liquidity before the next expansionary leg. It is fundamental not to chase the price at the peak of the move and instead wait for these discount levels to be tested. We are now switching to the 5-minute timeframe, the timeframe where precision meets execution. Looking at the chart from this detailed perspective, we can clearly see the formation of the 5M equal highs at the 1.18153 level. Notice how the price has generated a sideways consolidation just above the 1.18020 high daily. This price action is characteristic of an inducement phase. The market is building liquidity in the form of equal highs to entice sellers before making the final expansionary move. Below us, the imbalance we marked on higher timeframes continues to act as dynamic support. Our roadmap for the Eurist in these 5 minutes is to wait for the algorithm to decide to neutralize those equal highs and finally reach the PDH at 1.18218, thus completing this session's liquidity delivery cycle. We are now switching to the 3-minute timeframe, where price action reveals high-precision institutional movements. Notice how the Eurist pair has finally gained the necessary strength to pierce the 5M equal highs we were monitoring at 1.18153. However, the most interesting part of this transition is the appearance of the 3M order blocks situated just below the 15-minute imbalance. These order blocks represent zones where institutions have injected capital and typically serve as solid support during retracements. Observe that price is expanding decisively, but we now have two confluence zones, the 15M FVG and the 3M order blocks. As long as price remains above these levels, our projection remains bullish, targeting the external liquidity residing at the main PDH. Exercising patience and waiting for a retest of these marked zones will be the key to a low-risk entry. We are now switching to the 1-minute timeframe, placing ourselves right in the heat of the New York session open. As you can see, the Eurist pair has made a highly aggressive bullish displacement, finally successfully capturing the liquidity above the PDH at 1.18218. However, it is vital to observe the structure this movement has left in its wake. This vertical expansion has created a liquidity void and left unmitigated zones of interest at lower levels, specifically around the 1.18000 psychological barrier, marked here with a yellow line. In institutional trading, we know that these rapid moves often act as magnets for future rebalancing. Although the immediate trend is bullish, the presence of equal highs above and exposed liquidity below forces us to be cautious and wait to see if price decides to consolidate or if it will initiate a deep retracement to test the previous order flow. We continue under the magnifying glass of the 1-minute chart, where every detail counts toward understanding market psychology. I want you to pay special attention to the yellow line indicated by the blue arrow. This level represents the 1.18000 round number. In trading, these round figures act as institutional psychological levels where a vast amount of limit orders typically accumulate. Furthermore, notice the vertical line marked at 10 a.m. New York time. This mark is not accidental, it coincides with the release of medium-impact macroeconomic events, such as the University of Michigan consumer sentiment data. Historically, large investors use these volatility spikes to induce displacements contrary to the previous trend. After the strong morning bullish move, it is very common for price to use this time window to perform a deep correction toward the liquidity zones left pending at lower levels. We continue to meticulously analyze price behavior on the 1-minute timeframe following the New York Open. Notice how, after capturing the liquidity above the PDH, the Eurist pair has left us an HL label, meaning a higher low, at 1.18199. Structurally, this indicates that, for the moment, buyers are defending the upper zones. However, we must not lose sight of the macro context mentioned earlier. Although price seems to want to consolidate above the previous high, the proximity of the 10 a.m. window and the existence of inefficiencies such as the 15-minute FVG and the 3-minute order blocks far below suggest that this HL could be tested soon. The key here is to observe whether this immediate support level holds or if institutional volume begins to push price back toward the 1.18000 round number. We are at a moment of high operational tension, still on the 1-minute timeframe and with less than 5 minutes to go before the New York macroeconomic events are released. Notice how the Eurist pair has entered a clear sideways formation, compressing the price just below the new highs. This consolidation is the calm before the storm. Based on all the context analyzed, the PDH liquidity sweep, the lower imbalance, and the proximity of the 1.18000 round number, I have made the decision to execute a short position. The goal is to capitalize on the counter-move that medium-impact news typically triggers to clear the exposed liquidity in the 3M order blocks and the 15M FVG areas. We have positioned our risk professionally, trusting that the algorithm will seek to rebalance the price after the sideways distribution. It is exactly 2 minutes past 10 in the morning, and the market's reaction has been immediate and violent. As we projected in our analysis, the volatility introduced by the macroeconomic events has served as the perfect catalyst for our short position. Look closely at the strength of the current red candle. The Eurist pair has decisively broken the HL located at 1.18199. This price action definitively confirms that all the bullish acceleration we saw minutes before the news was, in reality, an institutional manipulation move. Its sole purpose was to induce retail traders into buying and to capture their stop orders above the highs before displacing the price in the opposite direction with the real order flow. Our position is now flowing in favor of the algorithm's true intent, targeting the lower liquidity zones. Closely observe the price action at this very moment on the 1-minute timeframe. The Eurist pair is attempting a bullish retracement, but notice the upper wicks the candles are leaving behind. The price tries to push higher but is systematically rejected by selling pressure. This inability of buyers to reclaim the PDH level is another vital technical confluence for our strategy. It indicates that the market has no interest in seeking new highs and that the predominant probability remains bearish. This exhaustion of demand, combined with the manipulation we previously confirmed, gives us the confidence to hold our short position. The algorithm is simply trapping the last buyers before initiating the aggressive displacement toward the 1.18000 round number and the lower liquidity zones. We maintain our focus on the 1-minute timeframe, where the Eurist is providing us with a textbook structural confirmation. Notice how the price has generated a BSL or buy-side liquidity level at 1.18239. What is truly significant here is that the market has not felt the need to push up and sweep that liquidity above recent highs to continue its descent. Instead, price is respecting the bearish order flow and has begun to print lower highs and lower lows at an accelerated pace. This transition to a bearish structure on the 1M chart indicates that supply has total control over the asset. The algorithm is now prioritizing the search for lower liquidity, the SSL or sell-side liquidity, completely ignoring upper buying incentives. This is a high conviction signal for our short position. We continue under the magnifying glass of the 1-minute chart, and I want you to notice a technical detail of vital importance for your development as traders. Look at how the price is actively consuming the liquidity in the lower zone, marked by the SSL level, while the upper liquidity or BSL remains completely intact and respected. This is a fundamental confluence. When the algorithm decides to ignore upper buying incentives to focus on sweeping the lows, it confirms the smart money's urgency to reach discount levels. They don't need the price to move up to gain more momentum. The supply is so dominant that the Eurist pair simply flows downward. Identifying which side of the liquidity is being attacked and which is being protected is the key to understanding the market's true intent in every session. As you can observe in the chart's evolution, the argument is validated with total precision. The price continues to pierce the SSL levels with efficient order delivery, showing not the slightest interest in returning to the upper BSL zones. This persistence in the bearish order flow is the definitive sign that institutions are liquidating positions before reaching the higher timeframe targets we set at the beginning. Maintain discipline and observe how the respect for the lower high structure remains unchanged while the lower targets are neutralized one after another. We continue with active management on the 1-minute timeframe. Notice how, following the bearish displacement, price has mitigated an internal order block. At this very moment, I have decided to move the stop loss to ensure the position is risk-free or at break-even. I want you to look at the yellow line indicated by the blue arrow at the 1.18120 level. For a trader looking to secure profits conservatively, this zone is a very valid technical exit point. In this instance, it offers us a 1-to-2 risk-reward ratio, though it's important to understand that, with practice, you will see this ratio vary. Sometimes it will be lower and other times higher, depending on what the market delivers. The key is to follow the plan and know when the value zone has been reached before the price initiates a possible reversal. We continue on the 1-minute timeframe, observing how the Eurist pair precisely tests the exit zone we had projected. Price has reached the 1.18120 level, reacting exactly at the yellow line we marked as our conservative target. This behavior validates our analysis regarding taking profits at internal liquidity levels. It is fundamental to note that, although price seems to stall here, the bearish structure remains the dominant narrative. The key to this test is observing whether demand has enough strength to initiate a significant bounce or if we are simply seeing a momentary pause before the algorithm seeks even deeper discount levels. As you can see in this session close, our thesis has been played out with pinpoint precision. The price has finished consuming all the liquidity in the lower zone, finally reaching our main profit target. At this stage, we have trailed the stop loss to the maximum to protect our capital, allowing the trade to conclude in the best possible way. If this technical analysis and institutional reading of the Eurist has provided value to you, don't forget to subscribe to the channel and hit the like button. Your support is essential to continue sharing these types of strategies. If you have any questions regarding the liquidity concepts or the management we performed today, please leave them in the comments. I always respond to your inquiries. Stay tuned, because I have much more advanced content to provide to help you on your journey as traders. See you in the next video.